Welcome everybody to the ETF Think Tank Happy Hour. I'm Dan Weisskopf, ETF professor and also co-PM of Block and lead ETF strategist for the ETF Think Tank, where we work with financial advisors around ETFs and offer great research, including Lyns research. And if anybody wants to learn more about Lyns research, definitely please email me or reach out to us. And by the way, Lyn, great book. Still reading it. Actually, I think you can probably teach a lot of people using this book for sure. And with that, I'm going to hand off the mic to David. You're up, man.
Thank you very much. How's it going, everyone? David Chikansky here, fellow portfolio manager within the Title Financial Group. Very excited for today's show. I'll kick it off to our co-founder, Mike Venuto.
All right, so Mike Venuto, I guess I don't have to announce that I'm the co-founder. So today, Chief Cat Herder, be moderating the chats. If you have a question for Lyn, go ahead and put it in there. We'll make sure we get you up here. And we really appreciate Lyn coming back. She was one of our first guests during the lockdowns early on many years ago when we started this, and we've both seen some enormous growth. Just achieve something that I would love to be able to achieve, which is publishing a wonderful book. I'm going to put a link to it in the chat, so everybody send some love and check out Broken Monkey, which we're going to use broken as our drinking word today as well. So with that, Lyn, if you would like to reintroduce yourself to the Think Tank cruise.
So my name's Lyn. I have a bit of a cold, so I'm probably gonna be coughing a couple of times. I apologize. So my background's engineering and finance, and so that's how I approach markets, and that's also how I approach my book, is basically the history of money through the lens of technology. And so I study basically how technology kind of changes both what we use as money and how we interact with money specifically. I feel like that's been an under-researched area, so it's something I've had a lot of interest in.
Wonderful. So I know Dan and David have a million questions, so I'm going to just let them get going, and then as the audience is ready to jump in, let us know.
Yeah, so I'll start off. Listen, Lyn, great book, Broken Money. Where'd you get your inspiration? How did it get titled, by the way? Let's start with just top down.
The title came later in the process. I wasn't sure for a while what the title would be. It just kind of hit me one day. The inspiration from the book, however, materialized from a combination of my research over the past several years. In particular, I wrote an article called "What is Money?" That was one of my longest articles. And I felt like it could deserve a full book treatment when combined with some other content that I've written. I originally intended to reuse more of my content, but I quickly found that almost all of it, I wanted, and was kind of writing it almost all fresh, except for a couple chapters that were kind of modular. And so the book is basically a couple key themes just kind of materialized in my head, which is basically the idea of money as a ledger. So comparing kind of two different types of monetary theory together. One, really emphasizing and exploring how the gap in transaction speeds and settlement speeds has really kind of shaped the world of finance. And so those are kind of like the main themes that the book materialized around, plus the kind of the super theme of just looking at money through the lens of technology. And so it's one of those things where I had thought about writing a book for a while, but I resisted it because it's a very long, time-consuming process. It's generally not good ROI. You don't write a book for money, especially if you work in finance. It's just there's almost anything else you can do as a better ROI. You write it when you feel like you can't not write it. It was too distracting not to write it. I just felt called to write it, and as we see from the reaction, people really like it, and that's because my heart was in it the whole time writing it, because it's just something that I was passionate about, and that's why I did it.
Does writing come easy to you, by the way? Because it's very challenging for me to sit down and write something, even just a page.
The funny thing is, so now it does. It did not used to. My least favorite subject in school was English. I like math and science. I did not like all the writing stuff. But just partially because I don't like writing about things I'm not interested in. So I'm kind of like, I'm interested in educating through writing about finance, about technology, things that I like. So financial writing specifically, I find it very easy to do. And so it's been fairly prolific in terms of just the sheer amount of content that I've been able to put out. It's just because it comes easy. But a lot of that was just from grinding. Like I had like an equities blog for years, and I sold that. Then I founded LynAlden.com, and I've been running that since late 2016. And just like after a while, I kind of built up the writing muscle. And so now it does come easy, but it did not always come easy.
You know, there's something in this book for everybody. My wife loves history, and you know, she would find this book intriguing just in the context of all the history and analogies that you link everything to. So I commend you on that.
I was lucky to have an editor. Joachim Book is his name. And he, in addition to being an editor, he has a master's in economic history from Oxford. So it was like basically the absolute perfect editor for this particular book. He's specifically a finance editor and a finance writer and a research assistant. So he helped fill out the citations. He helped fact check things. Because even though the book is not an academic book in the sense that it is written for, you know, a mass audience, but I wanted it to have a certain academic rigor to it. And so he helped ensure that it had that.
You know, and just to be clear for those who haven't read it or haven't seen the book, it's definitely not a book about Bitcoin. And it's, you know, it's broadly speaking a great book about the history of money, as you point out. But I kept thinking while I was reading, you know, that to some degree it is there is a narrative about the U.S. dollar here, in that you know, we're so advantaged here in America because we have the U.S. dollar that enables us to have so many advantages. When you're thinking about the history of the U.S. dollar and thinking about money, you talk about this a bit in your book, a lot in the book, right? Can you speak further about, you know, the dollar and how the history has evolved around that?
Sure, I covered the eras where Britain was the global reserve currency, and then how that transition eventually went towards the United States. And another thing I explore is the concept of instability, or the cost that generally a country has to pay in order to maintain that system. And so the dollar, basically, what's interesting about money is that in the current era, governments issue money. So in some sense, there's no competition among money. Like if you're in a country, that's just the money you use. But in a global sense, there is competition of money. So money emerged as the most saleable good globally in a similar way that, you know, commodity money would kind of compete with each other in the past. And so instead of Korea making deals with Thailand, making deals with Canada, and trying to figure out what's the payment terms going to be and who's going to do swaps and things like that, it's so much easier when they all kind of settle on one money for a lot of different international transactions. And that, of course, is the dollar, just due to the liquidity of the market, the openness of the market, the depth of the capital markets to reinvest surpluses into. And so really, and also Ray Dalio's done research on this, showing that when empires kind of rise and fall, there tends to be leading indicators or metrics and then lagging ones. So for example, education's a leading one. And what's interesting is reserve currency is a lagging one because it takes longer to build up. But then even after the other metrics kind of roll over, it takes a while for reserve currencies to change because they coast on their network effects for quite a while, because money is a network effect good. And so we've gone from this era of kind of three major eras in the telecom world. So since 1871, we've had three major eras. First was international gold standard. That broke with World War I. Then we had the interwar era, and then when we came out of that, we were in the Bretton Woods system. We were basically on a dollar system for most global trade, but the dollar was backed by gold. And of course, when that broke, we've been on the euro dollar standard, for lack of a better description, or the petrodollar standard, basically a dollar that mostly just rests on its own network effects, as well as certain strategic decisions with other countries to kind of help reinforce those network effects. And the cost of maintaining the system varies from system to system. So for example, the cost of the Bretton Woods system was that while we were on it, the US kept draining its gold reserves to maintain it, because you had the dollar backed by gold, and dollars were proliferating a lot more than gold was. And so that was kind of like just a poorly designed system from the start. And it only lasted about 12 years from the point that it was actually fully implemented. So people normally think of it as 1944 to 1971, but it really wasn't even fully implemented until the late 1950s. So it kind of like collapsed in like 13 years once it was fully implemented. And just the entire time, gold reserves went straight down in the US until they got to a point where they couldn't sustain that anymore. The current era, the resource that we draw down is generally our net international investment position, our industrial base, because in order to maintain the global reserve currency, we have to export a lot of dollars to the world. And so we do that through a structural trade deficit. And so as many of us are helped by the dollar system, so especially if you live or work near DC or New York, or other kind of intellectual property type of high margin industries, healthcare, tech, it's generally a decent place. But if anything that's like lower margin or more physical tends to struggle in this environment. So if you're a car maker or basically any sort of industrialist, it was better to be in Europe, it was better to be in Japan, it was better to be in China during these past 50 years. That kind of the best place to be kind of moved over time, but it was not really the United States. And that is kind of building to certain imbalances and excesses in a similar way that the Bretton Woods system had issues. So now after 5 decades of continuous trade deficits, we've built up a very deeply negative net international investment position. And some of the polarization we see, the political polarization in the country, can be somewhat tied to the fact that different regions of the country benefit or are harmed by the system by very different magnitudes. And so I think we get more kind of polarized politics, and just things are stretched now from having run the system for as long as we have.
So it's the dollar's fault and not Twitter, is what you're saying.
I think they feed on each other. I mean, Japan has social media, but they have tremendous kind of social harmony on it compared to other countries. But I do think that technologies are interesting in the sense that they can amplify things like this. So now Twitter is certainly changing our culture in ways.
Right. And the trade deficit is obviously an important factor of it, but it's not what's sped up our stance right now, where people are putting into question the solvency of our government, et cetera, right? That's been our own spending that's gotten us to that point. And knowing or thinking that we're forever the reserve capital of choice around the world is what's kind of foolishly allowed us to think that we can do this. But can we frame a little bit more now, like where we are in the context of economic cycles now, where it's assumed higher for longer is in place. The yield curve is pretty much flat. Treasuries have been destroyed. We talked briefly about real yields on tips being kind of near 20-year highs and what that really means. Will the equity market wake up? What's it going to look like when they fully do wake up to what's going on the fixed income side? If you could just give us some context on your economic thoughts in this.
So really high level context is that we had a 40-year period of falling interest rates and rising equity valuations. So both a bond bull market and a stock bull market, which fed off each other. And that was in large part because of like a 3-decade peace dividend we've had since the opening of China starting in the 1980s and really accelerating in the 90s and 2000s, and then the fall of the Soviet Union in the early 90s and the opening of those regions to the world. So basically, we had 30 years of bringing Western capital together with Eastern labor and Eastern resources, and so that was a tremendous multi-decade disinflationary force, which played a big role in letting those interest rates fall as steadily as they did, among other factors. And the problem is when you bounce off zero, like if you go to zero for a while and then you turn into using more and more fiscal stimulus, which is a more inflationary force, and run into any other shocks in the system, you get to the point where debt is super high, and it's no longer being offset by interest. So for example, we've had 4 decades of ever rising fiscal deficits as a percentage of GDP, but it's offset by that declining interest expense. And so interest expense as a percentage of GDP was flat to down for decades. But now it's kind of sharply rising back to multi-decade highs. And so if you are entering on average a more inflationary decade, because we've moved past part of the peace dividend, so Russian gas is not flowing to Europe the way it used to. There's rising tension between China and the US, even though there are still goods going back and forth. The rate of change is certainly different now. We're not like continuing to move factories there at the rate that we have been. So a lot of that is kind of behind us now. And so the physical world on average, I think, is going to be less disinflationary than it was. And that has pretty big implications for the financial markets, because if interest rates are no longer structurally falling, if they're in a sideways, choppy, range-bound way for a while now, I think equity valuations kind of also get stuck in kind of an equity, like a sideways, choppy period for a while. And so my general expectation is not a good decade for major equity indices in real terms. So that doesn't mean that you can't hit nominal new highs at some point, but it just means that compared to what you're getting on T-bills or TIPS, or just comparing against inflation, I think basically the broad U.S. equity indices are in for a kind of probably a lost decade in real terms.
I think if you would have told market participants 5 years ago that, inflation expectations going forward are this way and demographics are this way, like, in my opinion, that just means there's going to be all sorts of weird, funky inflation. Like, just the average spending patterns are just off. You could argue that's why consumption might be higher, but like, how do you wrap your head around inflation and negative demographic trends at the same time going forward?
So one is a lot of that older research implied basically that older people spend less, like older people are, but what we see in the current era is that because we've had a lot of wealth transfer over the years, like from the younger people to the older people, basically, normally by this point in prior generations, more of the wealth had been kind of transferred to the next generation, whereas both political power and wealth have generally remained concentrated in that higher age cohort. There's actually still a tremendous amount of consumer spending from those older demographics. And so if you're running very large monetized fiscal deficits to support older demographics, that overrides, in my view, the disinflationary aspects of demographics. In addition, there's a difference between a country aging alone versus the world aging together. So Japan aging alone, like it was the head of the pack in terms of aging, that's disinflationary for them because they're consuming less, but they still have, their whole stagnation occurred when China was on the rise and globalization was on the rise, that 30-year peace dividend I talked about. So they had plenty of labor offsets. Plus, of course, they're very, very strong in automation as well. And the challenge is if the whole world ages together, if China is aging too now, and if basically India and Africa are not going to be like necessarily the manufacturing powerhouses that China was, it's just a different environment. And especially the way we've kind of structured our fiscal frameworks, where it's a very top heavy demographics, but they're still owed quite a bit based on the structures we have now. And so that's not disinflationary. Now, if we did like tremendous entitlement reform and basically rug pulled that, I mean, that would be more disinflationary, but that's not politically viable. And so I think that we're going to see basically, on average, large fiscal deficits going forward, and that's one inflationary force. And on the other side, I think we're going to have an inflationary force and a disinflationary force. The disinflationary force is basically AI tech, things in the white collar world. Basically tremendous gains there probably in the next decade, huge productivity boosts. On the other hand, the energy market is pretty tight. other like battery metals or copper. I mean, the whole commodity complex is just not, these things tend to go in cycles, and there just has not been a lot of investment. Even things like drilling ships, for example, the basic inputs you would need if you even wanted to expand more energy production, like offshore, for example, that would take a long time to ramp up to really accelerate that. So both in terms of how much CapEx we're doing and in terms of even having the right tools to do that CapEx should we want to, is going to be an issue. So I think that basically blue collar labor, welders and HVAC technicians and you name it, I think that's going to be inflationary. I think infrastructure is going to be inflationary. I think energy and materials in general are going to be inflationary this decade. That doesn't mean you can't have, disinflationary recessions here and there. Inflation is not always a straight line, but I think that unlike the past decade where it's basically tech up and commodities down and bearish, I think this is a different decade now. I think this is the CapEx cycle has kind of worked itself out, and now we're looking towards more of that inflation of the physical world.
And that
Dan, before,
also suggests.
can I just ask one follow-on question on the demographic spending of the especially on the elderly, because that's something that's a surprise to me. Is that also data that came through prior to all this fiscal stimulus? So you don't anticipate it's going to change with like the excess cash kind of burning out in Q3? And then alternatively, is that excluding healthcare too, like the high levels of spending on higher demographics, or is it just primarily healthcare? Because I would have expected it's healthcare and all government stimulus is driving any kind of excess spending from that demographic, but I thought that would be helpful. So
it's also things like restaurants, travel. That cohort spends a lot there, which is why I think we're in kind of a tale of two economies right now. I mean, basically, there's certain interest rate sensitive areas that are really struggling, obviously, under the intentionally so. That's part of them trying to get inflation under control. But the fiscal expenditure is benefiting, especially upper middle class, older demographics, because that's, in any sort of economy, especially the US, which has higher than average wealth concentration, that's where a lot of that spending power is. And the interesting thing about interest expense and the reason these fiscal deficits can be concerning is that when you have an environment like the 70s where public debt was very low and most of the money creation was from bank lending, if you raise interest rates, it has a very disinflationary effect because you're putting a lot of downward pressure on bank lending, and any sort of offset you're getting from higher public interest expense is smaller. So the downward force is bigger. But if you go to, like, say, Japan's current situation, we have like 250% public debt to GDP and very little bank lending anyway. If you raise interest rates, all you do really is blow out the deficit. You arguably increase the rate of money supply growth if you were to try that, because you're basically the part of the spending that's like inflexible is just going to get more expensive now, and loan creation is not the issue anyway. The U.S. is kind of in the middle of those two extremes now, but we're certainly on the more of the Japan side of the situation, where when we have 130% debt to GDP, if you raise interest rates, all that interest expense is going to some people. It's going to, it's going to some entities like insurance companies and bond funds and banks in some cases. It's going to a lot of those, but it's also going to a lot of, cash rich, money market rich, T-bill rich, higher net worth, investors. And so that actually keeps some of their spending alive and going well. And so that fiscal deficit, I think, is a background inflationary force that is then competing with some of the disinflationary forces out there.
Yeah, you just touched on something that I want to highlight, right? Based on what you're suggesting, the U.S. may be a good place to invest, but there are other places to invest, like as you mentioned, Japan. What other countries are you excited about on the equity side that makes some sense as an investor?
So I like the India-Brazil combo because they kind of complement each other well. With India, it's largely a commodity importer. otherwise a very diverse economy, great demographics, fast growing economy. They're still under financialized, meaning that their banking sector is growing faster than their broader economy because you have pretty low levels of household debt. So there's still like unlocking of that financialization that comes. So a lot of China's growth over the past 20 years was debt fueled, whereas India's was more organic, more just development. So they've not grown like as thoroughly as China. They've not increased their standard of living as quickly, but they've done so largely without rapid debt accumulation. And so I expect that kind of long run train to continue. And Brazil on the other side is more of a value market where the demographics are not as strong. The valuations are way cheaper. It's a commodity exporter. And if my thesis of this being a better decade for commodities is correct, then Brazil should do pretty well, as long as it can maintain political stability, or at least as much political stability as you can expect. And so I generally like a lot. I also like Southeast Asia in general. Basically, I like a decent number of the emerging markets that kind of select emerging markets is what I would say. Basically, ones that are either doing well in terms of demographics, doing well in terms of commodities, and that don't have very perilous external debt situations. So countries that are have reasonable reserves relative to external debts, for example, they're not in the middle of a crisis. So yeah, a number of the BRICS countries I find interesting.
You did mention, though, that you did not anticipate India and Africa picking up the manufacturing sector from China. I think I heard you say that in one of your earlier answers. Can you elaborate on that further? Because I've been pretty bullish on India, and I've always kind of anticipated that, like, Mexico and India were basically splitting the U.S. manufacturing future. Like, Mexico is the friendly border state country that can manufacture, and I would expect India's manufacturing to pick up significantly, but I think you said you didn't. So I'd love to hear your explanation on that.
Well, I think in absolute terms, India's manufacturing will pick up. I just don't think they're going to be on I don't think they're going to be the world manufacturer in the way that China was. So it's got implications for India. Like, I think that relative to India's own economy, the manufacturing sector will grow along with it. It's just that when you look at manufacturing, it's not just facilities, it's also energy production. So China produces, for example, like twice as much electricity as the United States, which is remarkable. It's just a tremendous amount of power generation, and tremendous amount of resources that go into making that possible. And I think it's going to be challenging to replicate at that scale, to have that kind of surplus power to not only make a lot of your own stuff, but then make a lot of stuff and export it to the world. In addition, we're seeing China, even as they're always in the headlines for their like real estate bubble, kind of like just like train wreck happening right now. But the thing that they're not getting, I think, proportionate attention for is that their auto exports just had like a hockey stick rise. They went from not really exporting cars to just like 3 years. In 3 years, they are now like rivaling Japan as the world's largest car exporter with no sign of stopping. We don't see it in the U.S. We don't really buy Chinese cars in the U.S. But if you go to Egypt, for example, you'll see a tremendous number of Chinese cars on the road competing with European cars and Korean cars. And so China's now.
How do they drive? Is it fun to drive? Like, I don't know.
I would describe them. I mean, I haven't. They're kind of like Hyundais from like 20 years ago. Is basically they're entering on the cheaper end of the market, but they're really big in EVs too. So it's both ICE and EV. They're generally at the lower price point, but they're cars. They're like, it's like buying like it's kind of like how Japan undercut American cars, and then Korea kind of undercut Japanese cars, and China's now in that undercut game. They've moved up the ladder enough that they're, it takes a lot of work to assemble, a full car. And then also they just finished, now they have like a live production of their own aircraft. So in addition to Airbus and Boeing, now there's Comac out of China. They started that program in 2008. It took 15 years of development and testing and stuff, and now they've got this, and it'll take a long time to ramp up. But now there's, potentially basically an airplane exporter to, emerging markets. First they can start by saturating their own market a little bit more. So basically they can just trim their imports and use more COMAX, but then also over a decade, they can become a significant aerospace exporter. And that just takes a ton amount of time. And I think that India, while I'm very bullish on India, I don't expect it to kind of go the China path of being like the world's manufacturer.
I'm going to jump in and come back to the money. And I'm going to get it in there. The name of the book again, Broken Money. And we've kind of established some of the history of the system being broken. And I know we moved over to emerging markets for a little bit, but I know in our kind of pre-conversation, Dan kind of asked, is there any bright spot, right? Like, is there anything in the system? Is there any path out? And, I've heard Guyad rant about the Great Reset. I've heard all the coiners. I'm curious, like, what do you see as how this unravels and the system gets unbroken, I guess? Or is it just buy Bitcoin and we're all be okay?
I would have Bitcoin as a non-zero part of a portfolio. That's for sure. Obviously you have to adjust it for volatility. Generally, I mean, the way I would describe it is that countries are eventually gonna have to have a recapitalization. I don't like the word reset because that's got all sorts of connotations now, but just recapitalization, basically that they, barring some sort of productivity miracle, when you get this high sovereign debt relative to GDP, bondholders are unlikely to be paid back well in real terms. So if it was an emerging market, you'd have eventually default and restructuring. But of course, in developed countries, they control their own unit of account. And so the other options just inflated away or some mix thereof. We already see, I mean, this has been the worst 3 years nominally for bonds in US history. I've been a bond bear. Nominally, it's done even worse than I expected. I knew they'd do bad in real terms. I wasn't sure what they'd be like in nominal terms. They've done terribly in nominal and real terms. I'm not sure that I wouldn't really expect them to continue to do bad nominally, but I think that eventually that these positive real rates are unsustainable given the current level of debt, which is why I think that we previously talked about tips like locking in those real yields for a period of time. I think makes sense here because if you just run the numbers for the deficit, if you just have positive real yields going out a very long time, that gets exponential like very quickly. And so I think eventually this results in basically a longer term inflationary type of crisis until just things reset or recapitalize. And that's not like a next year story. That's like a decade story, maybe 2 decades. It's just a long thing. It's something that we're going to be reporting on and analyzing and memeing along the way as we go through kind of interesting times.
So we did mention briefly earlier in the show that it sounds like a lot of people here are fans of tips in the kind of once in a 20-year time horizon of like a 2.5%, 2.6% real yield. Long-term duration has gone down more in the last 850 days than equities did in 2008. Like, what is the turning point? Like, I listened to Gunlack and he was like, in the inverted yield curve, once it reverts, that's the point the market collapses. Like, is it going to be unemployment finally turns over, which seems like endlessly sticky? Like, what is this ultimate turning point that will really shake the equity markets into reality where everything else is getting priced?
I think part of it can be, I think we're already seeing early signs of it, is rotation out of big equities and gaining some interest back in bonds to at least slow the bleeding of bonds. We'll see if it actually reverses it or not more durably, but I think that the shock and awe part of the sell-off is most likely behind us, because if this were to continue, you get a situation like the UK gilt market last year, where you get kind of like an intervention at some point. So the way this ends is either natural rotation and those bonds start to kind of stabilize. I would expect them to, I wouldn't expect necessarily a tremendous bond rally, but I think you can eventually get to the end of this bear market. I think that we're not going to see another one of these big giant drawdowns again. Or you can have basically intervention of some sort, basically that when the reverse repos facility is fully drained, And if you get some sort of like treasury liquidity problem, like the UK gilt market ran into last year, and the US market also almost ran into last year around the same time. It was all kind of very wobbly together. Then you can get that, I think that's where you get a more inflationary outcome. You get a more stabilization in nominal yields and potentially an uptick in inflation. And so people who had locked in tips, I think, would be in decent shape in that environment. And so I think there's a couple ways this ends. And I think that most likely this big move is behind us because there's multiple reasons why that's not really sustainable.
Well, it ends with, I think what you're saying is some stability in the fixed income market doesn't mean that it ends with a big rally in the equity market, right? And the funny thing is, it seems to me like you're rationalizing what is attracting a lot of capital, which is these strategies, and I won't be specific here, on capturing option premium, right? Where you're getting big return back because there's so much volatility in the marketplace. Is that something that you've looked at all in the option premium market?
That's not an area that I focus on as much as you probably do. I've been focusing more on the systemic issues of kind of the workings of money itself, the big rotations in bonds, things like that. I'm not really focused too much on the volatility and the option side of things.
I'm the guy who always talks about how structure matters. Sorry about that. Thanks, Lyn. Dave, you got a question? I'll come back to the book.
I don't know. After this book, she might have stolen your title. So I think you have to hand it over to Lyn. So, so a lot of the move in interest rates in the Treasury markets over the last 30 to 45 days have been from just massive amounts of issuance into the market. What is issuance in Treasuries looking like going forward? I know it slows down a little bit for the rest of this year, but how big do you anticipate it being in 2024? Are we going to have another one of these 30-day, just oof, that was another 80 bips on the 10-year, right? Are there more of those periods in the near future?
So towards the end of the month, we have another Treasury refunding announcement, I believe. So we'll see what their anticipated supply is. They built up the TGA, the Treasury General Account, pretty aggressively in recent months. So I don't necessarily expect that growth to continue. So that can slow down issuance a little bit. A challenge is that if you merely hold interest rates where they are, let's say you just don't even hike anymore, you just hold them where they are, the existing interest expense still continues to refinance at much higher levels. So we're up to something like $900 billion a year in interest expense. But if you just have more and more and more of the existing debt come due and get refinanced, that number starts approaching $1.6, $1.7 trillion of interest expense. And then of course you have to add on any new debt on top of that. And so the challenge here is that, and that's why these positive real yields are hard to maintain, because it's a cycle that feeds on itself. The more the higher interest rates are, the more issuance comes out, and then that's a supply problem, and it potentially keeps yields high, and then even more has to come out. And so I basically think that large deficits are going to be with us for many years. And the source of buyers can change over time. If we do get a less hawkish Fed and a weaker dollar, you could bring in foreign demand again. A general trend that a lot of people are not super focused on is that when the dollar strengthens, usually the foreign bid for treasuries dries up because they're more in currency defense mode at that point. They're not in rapid accumulation of reserves mode. Whereas when the dollar weakens, that's when they generally go out and also weaken their currencies, buy more reserves. And so in this combination of a fairly strong dollar, fairly strong oil, not a lot of countries in a position where they can or want to rapidly accumulate treasuries. So Fed's selling, foreign sectors not buying, banks not buying. Almost all of it has to be absorbed by domestic non-bank entities, so households and asset managers, insurance companies, that kind of thing. But I think eventually when we do see an economic slowdown and we do see the Fed be less hawkish, more of that could be absorbed by a little bit by the foreign sector. We can get a bump there. So I just think this is a multi-year story. I don't think this is going away anytime soon.
Yeah, the scary part about what you're talking about is, and you said it in before the show started, you might see I can't even say it, like a lost decade, right? And that could be driven by, listen, if I can lock in 5-8% in terms of returns off of my bonds, why am I going to take a whole lot of risk in my equity market, right? So I totally get where you're coming from. I wanted to circle back though on technology, because you point out a lot of stuff in your book about technology, and we're looking at a future where technology is changing a lot of things, including, and you and I were talking about this before, about stablecoins as an example, and that's a technological evolution, right? Walk us through, in the context of your book, how you saw some technology change how and influence markets, and how you might see that in the future as well.
Well, so I think going forward, an interesting thing we're going to see more of is more competition between money and markets. And so with the current technology setup, countries have a pretty strong walled garden around themselves, in the sense that if you want to bring money in or out, there's really two main ways to do it. You can bring cash or gold through an airport, but only in very limited amounts, or wire transfers from banks, but they're of course fully controlled. And so people find themselves in these 160 plus different currency bubbles. You know, if you're in Egypt, that's just the one you're in, and you're getting 20% annual money supply growth, and that's the world you operate in. And it can be challenging to get your hands on other types of money. And that also applies to capital markets. It's hard for the middle class in many countries to go out and invest in a different capital market than their own. You know, wealthy people can access foreign accounts. It's harder for the middle class to do. And stable coins are basically offshore bank accounts for the middle class. And they pierce those walled gardens pretty effectively. So, you know, basically, over a call like this, you can show a QR code, and if I hired someone to do graphic design in country, like you name it, I can send them Bitcoin or stable coins, whatever they prefer, and it just goes directly to them, instead of going through their local banking network. And that has implications, because that basically makes it so that all the weaker currency and capital market jurisdictions have more points of competition with the stronger ones. They have less ability to retain a walled garden around their own system, and it's easier for their literally hundreds of millions, or really billions of people, to go out and seek money or assets on a more global basis. And in theory, you can tokenize a T-bill, so you can have an asset that actually earns yield. You can tokenize shares of a fund, for example, that's got all sorts of, it depends on regulation, financial regulation, and it comes down to whether or not those jurisdictions want their capital markets to be more accessible in small bits around the world. Most of them, in theory, should be interested in that as a possibility. And so I think that going forward, just basically these walled gardens are more porous, and this kind of 160 different currency block system is going to be harder to maintain. We already see that when an emerging market runs into a currency crisis, it starts to get forcibly dollarized, kind of, regardless of what the government wants, people just start having to defend themselves in various ways. So, when Lebanon hyperinflates, people turn towards dollars. And when Argentina has not quite hyperinflation, but very high inflation, people turn towards dollars. And all these technologies do is they keep making that even easier to do. So you don't have to get your hands on physical dollars anymore. You can get your hands on things like stable coins. And as those become just more and more liquid, same thing for Bitcoin, as they just become more big, more liquid, more understood, it really kind of, I think, disrupts this current 160 different siloed system we have now, and ties things more together, unless the country's, kind of willing to almost shut off its internet. Like basically, like as long as a country is reasonably internet connected, these porous holes exist now.
Yeah.
So
Wait, so I want to follow up with Eric Connolly's question, because he's always good about asking the detailed questions, the tough questions. So Lyn, sorry. ahead of time, because he's super smart. Can you compare the cost and transaction capacity per second of SWIFT versus Fedwire versus FedNow versus Visa debit?
Well, I think, I mean,
Did you get all that? Yeah. Did you get
Sorry,
all
man.
that?
Yeah.
I mean, let's simplify the question down so that we
Yeah.
can like there are multiple different broken systems of moving money around that are either connected to a government or banks or credit card companies. Like, I think the question is the cost warranted? Is it really, why are they different? I think that's
Well,
where
how they
Eric's going.
compete
I don't know.
against one
Oh,
another
there's
too.
Eric. Eric,
Yeah,
you want
no,
to chime in and
Yeah.
clarify where you wanted to go, or are you driving?
No, I just want to finish. Yeah, I'm just curious, like, what's the cost per transaction for each of those, just as a benchmark against which every new technological innovation has to compete? My understanding is that Fedwire is pretty cheap and likely to get cheaper as adoption increases. But what is the cost versus Swift, which was, state of the art 20, 30 years ago?
So the cost in general, it depends on if you're looking at domestic or international. So Fedwire is interesting because it's not a typo. It processes literally a quadrillion worth of gross settlement volumes per year, which is just a remarkable figure. And it does that with only about 200 million transactions, so about as much as Bitcoin can do. And it's because the average transaction size is like $5 million. So it's an absolutely enormous amount of money that settles, and it's cheap. And of course, most financial innovations over the past 200 years have basically been more efficiency at the cost of more centralization. Basically, they say, look, if you just let us do it with our gigantic spreadsheet, we can make this thing nearly free, and just trust us, bro. Right? That's kind of been the model over the past 200 years is efficiency at the cost of centralization. And another result is that we have all these different silos. So, the US is obviously the biggest interconnected market, but then there's other systems. There's, in Africa, like mobile pay type of environments that are generally these kind of walled gardens. There's lots of different systems. I think an interesting model to start thinking of is email. So with email, you have open source protocols connecting different email clients, right? So if you use Gmail, you can send an email to someone that uses Yahoo, for example, or if someone's still on AOL or their own hosted email server. There are all these different environments that share a open source connection with each other. And that, I think, is one of the opportunities out there, is for different environments to still exist and retain their own efficiency to the extent that people want to use them. But now there's more possibility for points of connection between them, that they can actually communicate across walled gardens rather than just be inside their own walled garden. And then also, if people just don't like the underlying unit of account, it's not just about the transaction efficiency, it's just whether or not people want a different unit of account. If you're in a country that has 15, 20% annual money supply growth year after year after year, and it used to be hard for you to get dollars, and if it becomes way easier to get dollars in the future, or if Bitcoin gets bigger, more liquid, and less volatile, whatever the case may be, you can even have like gold-backed stable coins out of Switzerland. They exist, right? Whatever asset someone wants now, as they get more just understood, accessible, liquid, that's just a different unit of account that people can opt into if they just don't like the unit of account in the environment that they've been stuck in. And you look at credit card transactions in general, they're about 3% for the merchant side. I think that's disruptable. I think another topic to be aware of is micropayments. So if you want to send 30 cents to someone internationally, it's actually not trivial to do that. It's you think it would be, but it's like, if I want to send someone 5 cents or 30 cents internationally, just it's hard. And of course, you might think, well, why would you ever want to do that? And it's like, well, AI might want to do that. And an example recently was, for example, if someone in country XYZ wants to use, ChatGPT, instead of having like a subscription, there are services that can open the API. You can ask a question for, a micro cost, for example. using things like the Lightning Network. That there's been like little trials like that that are kind of fun. And you can also then have AI models that, if you give them a task to go do something, you can also give them like, say, a Lightning balance. And if they need certain resources, like certain API access or access to like, just more hardware to process something, they could pay another service on like a per use basis. And the reason that's relevant is because whenever you have a big hardware constraint, there's risks of chargebacks. So for example, if I am running a bunch of GPUs and I'm offering AI services, if I have like an open API where people can kind of like pay in credit cards and use the machines, and then they do chargebacks, unlike a mostly software service, that's actually a pretty hardware intensive thing. I've had to use electricity and real world resources that I don't get back. And so that kind of real time settlement for those hardware services is relevant. And so I think that micropayments, especially international micropayments, are another use case that the current system is not really well designed to do. Any given walled garden can potentially handle micropayments, but when you start to talk about micropayments between walled gardens, that's where some of these open source things I think start to have a competitive advantage.
Love it. Thank you.
All right, David, we'll go to you. I'm glad you went to AI because I was going to ask about that as a technology. And I feel like 3 months ago, that's all anyone talked about. And the truth is so many good things have been done in the last 3 months while the conversation has gotten quiet. But David, you go ahead with your question.
Yeah, I was going to ask. Some believe that as our inflation was primarily a supply-driven inflation issue, that really we could lower our debt interest payments if we focus more on the balance sheet instead of the short end of the yield curve. Right? We talked before the call on the thesis that like the yield can't be inverted that much because the boomers will just lock in their interest rate for the rest of their life for the first time again that they haven't been able to for a very long time, for decades. So whatever the yield curve is, it just can't, in my opinion, it can't be that steep because I think there will be a lot of demand from US investors. And the other thesis is that with the government in so much debt and households with such wealth, that's actually increasing inflation over time because you're literally paying them 5.25% on their cash, whereas the government is, completely broke. What are your thoughts on that, on like short-term rates or like the Fed funds rate versus balance sheet as inflation fighters in this type of environment?
Yeah, so I think that in this recent period, I think the balance sheet reduction has been a more effective tool than interest rates in some cases for trying to slow down this inflation. And as you point out, that's the problem with fiscal dominance. When you have very high public debts, interest rates just become an increasingly less effective tool for fighting inflation. And if you get high enough debt, like Japan, they actually can be a pro-inflationary tool. Like if Japan were to raise interest rates like 3%, there's actually a possibility that would increase inflation just because it actually would potentially result in more money creation than it's currently happening. And that's just kind of the extreme environment you get when you get that high public debt load. The United States is more in this like limbo phase where raising interest rates has some disinflationary effects, but also some inflationary effects that kind of balance each other out. The problem with using the balance sheet tool is that you can only run loose fiscal policy and tight monetary policy for like a certain period of time, because eventually it becomes hard to place all of that debt issuance. And so that's, it's during that, say, 2-3 year period where you can do that, that can be very effective. But then the question becomes when you do kind of run out of liquidity, if your bond market becomes illiquid or, problematic, that's when you get potentially like a intervention type scenario. So one of the challenges of a fiscal dominant environment is that the central bank, both of their primary tools for fighting inflation are mostly based around like changing the rate of bank lending, right? So most things are based on, if there's low inflation, what can they do to get banks to lend more? And if there's high inflation, what can they do to get banks to lend less? But if that is a smaller component of what's driving inflation, because you have very large fiscal deficits, it's just partially outside of the hands of the central bank because their tools are just not really designed to deal with fiscal. And the best they can do is offset fiscal. So they say, well, if fiscal is going to be inflationary, maybe I can slow down the private sector enough that I can offset part of it. That's kind of what we're doing now. But of course, that can only be done for so long. So I think that overall, just the central bank's tools start getting more limited over time. And that's why these sovereign debt cycles tend to be kind of unusual compared to the normal cycle.
So Lyn, 2 years, 5 years, 10 years, is the US dollar higher or lower versus, oh goodness, oil? Or
Oil.
You
Are you
just
asking if
asked
oil's
her-
going to be up or down?
You
Like,
asked her the price of oil. You didn't ask her the dollar.
yeah,
How about
Yeah,
I
I mean,
guess
that's
if
not
asking
I know where
necessarily
you were
fair.
going though, Dan.
I'm trying.
Yeah.
I'm not trying to lock you in on the question around Bitcoin because it's not really relevant to my question. I'm trying to figure out because everything is tied to the dollar, right? And that gives us dominance, but I don't know that it's really, the dollar strength is always justified, and somehow we manage to manipulate the dollar higher. But I don't know when we've got so many things going against us, such as China or oil.
I don't think we're manipulating the
Japan.
dollar higher. When you have liquidity squeeze, people are running towards the liquid asset, which is the US dollar. Like,
Well, you're presuming that the central banks and the Treasury don't manipulate the dollar.
Well, there's
Yes,
also
sir.
inflexible demand for the dollar in the form of $13 trillion in offshore debt, dollar denominated. So there's 13 trillion out there, and all of that. Anytime you have a debt, you have a demand for the unit that can cover your debt. And so a lot of times that's also why you see inverse demand. Like when the dollar is strong, you see less treasury demand, because if anything, they're selling treasuries to get dollars to service their debts or otherwise defend their currency. And what's interesting about that whole $13 trillion of offshore debt is that most of it's not even owed to the US. It's like, China will lend to, country XYZ,
Yeah.
or another, it's like owed from one country to another country in dollars. But all of that represents a certain type of dollar demand. And so when you harden the unit of account, like if the US does tighter monetary policy as it did recently, basically you're hardening everyone's debts. And so that causes, in addition to its general liquidity, that causes that sort of surge. Now, like comparing it to what it's going to look like versus other assets in 5-10 years, I mean, I would expect energy and many commodities to probably be higher in dollar terms than they are now. As for the dollar index itself, I mean, that's largely a question of the euro. How much can Europe stabilize its energy situation? That's kind of the big question for them. So that's more of like I would consider that more of a geopolitical question than a finance question, to see if they can kind of get their energy situation stabilized. But in general, I would expect most kind of real assets to have increased in price versus the dollar. I think that big US equity markets might be slightly higher versus the dollar, but probably didn't do very well in real terms when looking back 5-10 years from now. It would be my guess. But nobody has a crystal ball.
Big bucks.
You're amazing, Lyn. Like you answered the question we couldn't even articulate. So no offense to Dan. I know
No.
what you meant, and Lyn figured it out.
You always say that, by the way.
perfect.
She completely agreed with me, by the way.
yeah.
No.
In your
It was
comment
a
on real
good
assets,
question.
can I just ask you to
No
clarify?
more, David, no more.
Well, that
You have to look at the
real
clock.
estate versus
No,
commodities. So
No more. Listen, Lyn, we know you fought through a cold to be here. We always appreciate your insights. We love sponsoring your research. I put it in the chat there. If somebody wants access to Lyn's research, the think tank is happy to sponsor. The book's amazing, Broken Money. We really appreciate you getting it there. The link is there as well for that. Next week we've got a pretty awesome show as well. You might want to come back because I know you love options as well. But next week we're having 3 people come speak about options. We have Jay from Zega, who's behind the Yield Max suite as well. We have Sylvia from Defiance, who we just recently did the 0 DTE funds with, and then we have Meb Faber. He's going to be talking about tail and fail. So 3 unique option strategies and specialists talking with us. Should be a good show. Again, Lyn, feel better. And congrats on the book. And thank you very, very much.
Thank you.
See you all next week.
You're welcome. Thank you.